the implications of new dividend tax rules. Dramatic changes to dividend taxation took effect in April 2016, and these changes have far-reaching implications for business owners. One significant change was the abolition of the old dividend tax credits. These credits, which for so long enabled business owners to utilize dividends as a tax-friendly alternative to salary, no longer exist, meaning that dividends are now subject to a wide range of tax liabilities. Another significant change was the abolition of the old 10% tax, which has now been replaced by a flat-rate personal dividend allowance of £5,000 per person. But how are dividends above this new allowance taxed? Under the new rules, any dividends above the £5,000 personal allowance will be subject to tax at the following rates: 7.5% if dividend income is within the standard rate, 20% band; 32.5% if dividend income is within the higher rate, 40% band; 38.1% if dividend income is within the additional rate, 45% band. To put things into perspective, here are a couple of examples outlining how the changes are likely to affect your company's shareholders depending on their income situation. In the first example, if a shareholder receives less than £5,000 per year in dividends, that shareholder won't have to pay tax on dividend income, as the amount will be within their dividend allowance. In the second example, if a shareholder receives dividends of £600 from shares invested in an ISA, no tax will be due on dividend income within the ISA, whatever rate of tax this shareholder pays. In the next example, if a shareholder has a non-dividend income of £6,500 and a dividend income of £12,000 from shares outside of an ISA, things get a little more complicated. In this case, as the shareholder has a personal allowance of £11,000, £4,500 of the dividends are under the threshold for tax. A further £5,000 comes within the dividend allowance, leaving tax to pay at basic rate 7.5% on the remaining £2,500. Also, if a shareholder has a non-dividend income of £20,000 and receives dividends of £6,000 outside of an ISA, this shareholder won't need to pay tax on the first £5,000 of dividends due to the dividend allowance, but will pay tax on £1,000 of dividends at 7.5%. Finally, if a shareholder has a non-dividend income of £18,000 and receives dividends of £22,000 outside of an ISA, then of the £18,000 non-dividend income, £11,000 is covered by the personal allowance. The remaining £7,000 is taxed at basic rate. Meanwhile, of the £22,000 dividend income, the dividend allowance covers the first £5,000. The remaining £17,000 of dividends are taxed at the basic rate, 7.5%.